$1, $7 trillion. Let that land. That's not a bad day. That's not a pullback. That's a number so big your brain tries to turn it into background noise just so you can keep scrolling. It's bigger than the annual economic output of entire countries. It's a mountain of paper value that, at least on screens, appeared to vanish from the precious metals market in roughly the time it takes to make coffee, answer a few emails, and glance back at your chart. And if you were watching it unfold, you probably felt the same thing almost everyone felt. Confusion first, then a flash of fear, then that terrible urge to do something, anything right now. The candle is red, the spreads widen, social media starts yelling manipulation, and your nervous system wants to hit the sell button just to make the discomfort stop. Here's the wild part. The move wasn't random. It wasn't unexplainable. It wasn't the market waking up and choosing violence for no reason. There were fingerprints all over it, clear patterns that have shown up before for decades. This morning, gold was hovering around $500. Silver ripped to roughly $117, $75 an ounce, a fresh all-time high in the story being told. Then, in about 90 minutes, the celebration turned into a siren. Silver dropped hard to the low 100s, and at one point, looked like it wanted to fall through the floor. Gold slipped to around $5,000. On the surface, you could summarize it in one sentence. Gold down about 2%, silver down about 12%, and everybody suddenly acting like the sky is falling. But that one sentence hides the most important clue. Same sector, same time window, two totally different reactions. Why did silver get punched in the face while gold mostly took a bruise? Because the precious metals market isn't one emotion. It's two different personalities wearing the same jacket. Gold is often treated as a monetary metal, a macro hedge, a store of value story. Silver is that plus something else. It's smaller, thinner, more speculative, and more exposed to industrial demand narratives. That combination makes it more explosive in both directions. When silver moves, it doesn't stroll, it sprints. But there's also a more specific reason. Silver ran into something gold didn't. To understand it, you don't need to be a chart wizard. You just need one concept: support and resistance. Imagine you're in a room bouncing a rubber ball. The floor is support. The ball hits it and pops back up. The ceiling is resistance. The ball smacks into it and drops. In markets, support is a price area where buyers reliably show up. Resistance is a price area where sellers reliably show up. When price falls into support, buyers defend it. When price rises into resistance, sellers fight back. Now, here's where it gets sneaky. A level that acted like support in one era can become resistance later, and vice versa. The floor can become the ceiling. And when price hits that ceiling at high speed, especially after a hype-filled run, it doesn't gently drift lower. It can snap down. That's also why all-time highs are emotionally dangerous. When price prints numbers nobody has seen, it feels like open sky, and open sky creates FOMO. FOMO creates late buyers. Late buyers aren't stupid, they're human. They see a chart going vertical and assume the next candle will be the same direction. But when a vertical move meets a hard ceiling, those late buyers become the fuel for the reversal. They don't just lose money, they become forced sellers at the worst possible moment. That brings us to the long-term chart that explains the whiplash. Zoom out. Not a one-day chart, not a one-week chart, decades. For many years, from the mid-1990s into the early 2010s, silver's price action can be viewed as moving within a broad, downward-sloping channel. Two diagonal boundaries guiding swings, with price bouncing between them like it was following invisible rails. If you're new to channels, think of them as tilted floors and ceilings. In a down channel, each bounce tends to top out lower than the last. In an up channel, each dip tends to bottom out higher than the last. These aren't magical lines that control reality. They're a way to visualize repeated behavior, where momentum tends to stall, where buyers tend to step in, where sellers tend to press. Inside that multi-year structure, there was a line, a midline, a do not ignore this zone, where silver repeatedly reacted. Call it the white line, the anchor, the level that keeps showing up at turning points. Price treated it like a decision point. Are we continuing or are we reversing? Back in 2008, during the financial crisis, silver fell hard and tagged that line around $8 an ounce. And what happened next is why long-term structure matters. After touching that line, silver didn't just bounce, it launched. Over the next couple of years, it ran from roughly $8 to about $45 in 2011, around a 462% gain. That was the ball hits the floor moment. The level behaved like support. Now fast forward. Since roughly 2014, silver has spent long stretches inside a newer upward sloping channel, different rails, different trend, and then this week, price sprinted up and collided with that same white line again. Same line, same zone, but not the same approach. In 2008, silver was falling from above and landed on the line. Support. floor. In 2026, silver was rising from below and ran into the line. Resistance, ceiling. That one difference, the direction of the approach, matters more than most people realize. It's why the rejection looked violent. It's why the drop felt like someone flipped a switch. When a market screams upward into a multi-decade resistance zone, you can get a perfect storm. Profit takers who planned for that level, short sellers who wait patiently for that level, and late buyers who piled in right before the wall. When the wall holds, those late buyers become forced sellers. Forced selling is never polite. It's fast, messy, and emotional because it isn't always a choice. And this is where gold's smaller drop starts to make sense. In the story being told, gold didn't collide with the same kind of multi-decade decision line in that moment. It got dragged by the broader precious metals wave, but silver took the direct hit because silver ran straight into a line the market has respected for decades. So that's the technical trigger. A major long-term resistance area where the floor became the ceiling. But charts explain the where. They don't always explain the why right now. For that, you have to look at the market's plumbing, especially leverage. Silver's move today didn't feel like normal selling. It felt like liquidation. The kind where traders aren't selling because they change their mind. They're selling because they have to. And the thing that flips I might sell into I must sell right now is usually a change in margin requirements. If you trade futures, you're not paying the full value of the metal. You're posting a fraction as collateral, margin, while controlling a much larger position. That's leverage. It's powerful. It's also unforgiving. Here's the math in plain English. If silver is $100 per ounce and a contract represents 5,000 ounces, that's $500,000 of exposure. Yet you might only need something like $20,000 of margin to hold it. A $1 move in silver is $5,000 on that contract. A $10 move in silver is $50,000. In a market that can move double digits in an hour, you can see how quickly manageable risk becomes account emergency. Now enter the exchange. When the exchange raises margin requirements, it's like raising the minimum down payment. Suddenly, the same position requires more cash collateral. If you're sitting on extra cash, it's annoying. If you're fully leveraged, it's a crisis, because you have two choices: deposit more funds immediately or reduce your position. Most traders can't add cash on short notice, so they sell. And when thousands of leveraged traders are forced to sell at the same time, you don't get a gentle dip, you get a cascade. Price drops trigger margin calls. Margin calls force more selling. More selling pushes price lower. It snowballs. According to the narrative circulating, the CME raised silver margins sharply. Figures being discussed are around a 47% increase, from roughly the low $20,000 per contract to about $3,200. Whether the exact numbers are perfect or not, the mechanism is the same. Leverage got squeezed and the market flushed. So stack the two triggers together, and today's move starts to look less like chaos and more like a recipe. A long-term resistance level created the place for price to stall and reverse, and a margin squeeze turned that reversal into a liquidation cascade. One trigger was technical, the other was mechanical. Together, they produced the kind of 90-minute candle that makes people swear off trading forever. And yes, this combination rhymes with history. In the late 1970s and into 1980, silver surged dramatically and then crashed when rules tightened and leverage broke. People reference Rule 7 and other restrictions as the moment the air got let out. In 2011, silver surged again, and margins were raised repeatedly in a short span. People often cite a cluster of hikes in days. The market cracked. Then it kept hurting long after the initial break. So when you see a massive run followed by margin pressure and a violent drop, you're right to pay attention. But familiar doesn't automatically mean identical, and that's the part people miss. The big question isn't, did we crash? The crash already happened. The real question is what kind of crash this was. Was it a terminal top, like the kind that begins a long bear market? Or was it a brutal shakeout inside a bigger bull trend, like the kind that destroys leverage and then sets the stage for another leg higher? Let's look at both sides with honesty. The bearish case is straightforward. Silver's run has been extreme. In the story being told, it's up roughly 270% over about 12 months. That's not a normal move. That's a sprint. Parabolic moves can be self-fulfilling on the way up and self-destructing on the way down. Crowded positioning makes markets fragile. When everyone is leaning the same way, the market doesn't need bad news to fall. Sometimes it just needs fewer buyers. There's also the gold to silver ratio. When silver outperforms aggressively, that ratio compresses. Sometimes that compression is healthy. Sometimes it's a rubber band being stretched. When the rubber band snaps back, silver can underperform violently as the relationship normalizes. That snapback can happen fast, and it doesn't care how bullish your long-term thesis sounds. And then there's the margin signal itself. Whether margin hikes cause tops or simply appear when markets are overheated, They often show up near turning points because exchanges raise requirements when volatility spikes and risk rises. It's like a nightclub raising the cover charge once the room gets too wild. It doesn't create the party, but it changes who can stay inside. Now, the bullish case, fundamentals don't change in 90 minutes. A chart can flip your P&L in an hour. It can't magically create new mines, rebuild inventories, or erase industrial demand overnight. The bullish narrative points to structural tightness and structural demand. A large portion of silver supply comes as a byproduct of other mining, so supply can't ramp instantly even if price screams higher. New mines take years to plan and develop. New processing capacity doesn't appear because a chart went viral. Demand, meanwhile, is being framed as structural. Solar manufacturing consumes large amounts of silver. Some claims put it at around 200 million ounces per year and growing. EVs and charging infrastructure use silver. High-end electronics, 5G buildouts, and data centers use silver. The point isn't that every number is perfect. The point is that industrial demand doesn't vanish because futures traders got shaken out. There are also policy and trade dynamics. In the story being told right now, China's restrictions on silver exports, described as taking effect on January 1st, remain in place and are said to influence a large share of global flows. Add claims of multi-year supply deficits, 5 consecutive years where demand exceeded supply, with figures like an 820 million ounce cumulative shortage being thrown around, and you get a market that can stay tight even after a violent paper sell-off. Then there's inventory. People cite big drawdowns in deliverable stocks, sometimes saying registered inventory has fallen from something like 86 million ounces down toward 28 million. Again, you can debate exact figures, but the concept is simple. If the metal that is readily available keeps shrinking while demand stays strong, the market becomes more sensitive to shocks. And this is where the paper versus physical split becomes important. There's a paper market where contracts trade, and a physical market where actual metal is bought and sold. Usually they move together. When they don't, it can signal stress. During sharp paper sell-offs, you might expect physical prices to fall in lockstep. But sometimes physical demand surges because buyers view the dip as an opportunity, and dealers don't lower premiums much because they're selling quickly. So the paper price drops, but the all-in physical price doesn't drop nearly as much. In the story circulating today, that's exactly what people claim happened. While paper silver dropped fast, physical premiums didn't collapse. Some even rose as buyers rushed in. That matters, because if the bull case was truly dead, you'd expect real-world demand to cool and premiums to shrink. When premiums stay stubborn, it's a hint that the paper market move may be about leverage, not about a sudden lack of physical appetite. Some commentators push the idea further by pointing to ratios of paper claims, to available physical inventory in certain venues, throwing out huge numbers, figures like hundreds of claims for every ounce that is registered and ready for delivery. They compare it to an airline overselling seats. It works until too many people show up for the same flight. Whether you accept the exact ratio or not, the point is simple. Paper exposure can dwarf immediately deliverable metal. That structure can run smoothly for years, until the day it can't. And if you want a modern reminder that paper price and physical reality can collide, look at other markets that have experienced stress. In 2022, nickel became a headline because the market's structure and positioning helped create extreme volatility. The details are different, but the lesson is the same. When positioning is crowded and real-world availability becomes tight, price can move in ways that feel impossible, right up until the minute they happen. Now zoom back to the white line, because this is where many people misread history. And when silver touched that major line in 2008, the move that followed was extraordinary. But the path wasn't a straight line from $8 to $45. There were brutal shakeouts on the way up, 30% and 40% drops that made people swear the bull market was over. Volatile bull markets don't reward comfort, they reward survival. That's why the 462% after the touch story is true and misleading at the same time. True, because the move happened. Misleading, because it makes it sound like the ride was smooth. It wasn't. The ride was a roller coaster designed to throw people off. In more recent history, the same pattern shows up. In March 2020, during the early COVID panic, silver dumped hard with everything else. In September 2020, it had another sharp shakeout. In 2011, it cracked and took a long time to heal. Each time, the move felt like the end in real time. Later, it looked like a chapter break. That doesn't guarantee the next move will match the past, but it reminds you of something crucial. A violent drop is not automatically the end of the bull case. Sometimes it's the market resetting itself by burning out leverage, and that's also why the bounce matters. In the story being told, silver slammed down toward the low hundreds, then snapped back toward the high hundreds shortly after. Moves like 103 up toward around 109. That doesn't prove anything on its own, but it does hint that buyers are still alive and the market is now in a tug of war instead of a one-way stampede. So what matters now is what you watch next, not what you fear next. If you want a clean framework, focus on 5 signals and think of them as a dashboard, not a prophecy. First, psychological levels. A number like $100 becomes a battlefield because humans trade round numbers. If price stabilizes above it, consolidates, and stops printing lower lows, that's evidence the flush was a reset. If it breaks and stays broken, the market may need more time to cool. Second, physical premiums. If premiums collapse after a paper drop, that's bearish. If they hold or rise, it suggests real demand is still there. Watch what dealers do, not what commenters scream. Third, inventory trends in major delivery venues. You don't need to obsess over every daily wiggle, but direction matters. Tightening supports the bullish story. Rebuilding weakens it. Fourth, policy and export restrictions. If restrictions remain, supply stays constrained. If they ease, the market can breathe. Fifth, margin policy. If margins rise again, more forced liquidation can follow. If the margin shock is a one-off and volatility calms, the forced selling pressure fades. If you want a sixth signal that people ignore, watch behavior, not headlines. Does the market panic and stay panicked, or does it flush and then stabilize? Do dips get bought quickly, or do rallies get sold immediately? That is the difference between a trend resetting and a trend reversing. Now, the part that needs to be said clearly, I'm not a financial advisor, and this isn't financial advice. Silver is brutally volatile. Prices can go lower from here. If you are leveraged, margin changes can wipe you out, even if you're right long term. Being right doesn't matter if you get liquidated before the story plays out. Use risk controls, understand your exposure, respect the possibility of another move that feels just as insane as today. Which brings us to the question everyone asks after a move like this. Was it manipulation? Suspicious timing is possible, and proving intent is hard. You'll hear claims about banks, about positioning, about who is long, who is short, and who allegedly holds physical metal. You might hear rumors about institutions with large losses, or institutions quietly accumulating physical supply. Some of those claims might be accurate, some might be pure theater. Either way, getting emotionally locked into the villain story doesn't help your strategy. Even if you assume the worst, the practical response is identical. Manage what you can control. Position size, risk limits, avoiding leverage you can't survive. Having an exit plan before panic writes one for you. Leverage is what turns a temporary drawdown into permanent damage. You can be right on direction and still get wiped out if you're forced out at the worst moment. Being right doesn't pay if you can't stay in the trade. So what do you do with all this? There are 3 types of people watching a move like today. The first is the person who panicked and sold. You saw the drop, you felt the fear, and you hit the button just to stop the pain. I'm not here to insult you. Fear is normal. But if the decision was purely emotional, it's worth asking a hard question. Did you exit because your thesis changed, or because your nervous system couldn't handle volatility? If it was the second, that's not a moral failure. It's a position sizing problem. A position that is too big isn't defined by the number of ounces or shares. It's defined by how it makes you behave. The second is the person who wants to buy the dip. You see the red candle as a discount, and you want in. That can be smart in bull markets, but timing matters. Bottoms are processes, not single candles. In a market like silver, the better approach is often scaling in, not swinging for a perfect entry. Let the market prove it can hold, consolidate, and stop bleeding before you bet the farm. If you're wrong, scaling limits the pain. If you're right, you still get exposure without needing to be a hero. The third is the person with no position who's watching from the sidelines. And honestly, you're in the best spot. You have options. You can observe without being forced. You can wait for clarity. You can learn the signals while everyone else is trading emotion. Being liquid is a strategy. Now let's circle back to the opening line. $1, $7 trillion gone. Did it really disappear? Not exactly. In markets, value doesn't evaporate, it transfers. When prices fall fast, someone sold in fear and someone bought with patience. Someone got liquidated and someone stepped in with cash. The money didn't vanish. It changed hands. And that's why days like today matter. They reveal who was stretched on leverage, who was chasing, who was managing risk, and who was waiting for volatility to create opportunity. This is the part most people don't want to hear. Markets are built to transfer wealth from the impatient to the patient, from the emotional to the disciplined, from the over-leveraged to the unleveraged. Volatility is not a glitch. It's a feature. Zoom out one more time and you'll see the bigger backdrop people keep pointing to. Global debt levels are massive. Some commentators cite figures like $38 trillion in U.S. debt alone and argue that debt this large is not realistically paid back in hard terms. It gets diluted over time. They also point to central bank balance sheet behavior and ongoing liquidity operations, such as claims of tens of billions per month in reserve management purchases. Whether you agree with every number, the macro narrative is clear. If money is continually created while finite real-world resources remain constrained, tangible assets tend to stay relevant. That doesn't mean precious metals go up in a straight line. It means the long-term backdrop can stay supportive while the short-term tape tries to shake you out. Markets don't reward people for being right. They reward people for managing risk long enough for being right to matter. Silver can drop 12% in 90 minutes and still be in an uptrend on a one-year chart. It can also bounce hard and then drop again. That's the reality of a market that mixes macro fear, industrial demand, and leverage. If you want to be in this arena, treat volatility like weather. You don't get angry at it, you prepare for it. You size positions so a storm doesn't end your season, and you make decisions when you're calm, not when the screen is flashing red. So here's the grounded conclusion. Today's move had structure. A long-term technical level acted like a ceiling and price reacted. A margin squeeze likely amplified that reaction into a liquidation cascade. Those two forces can easily produce a 90-minute flush that feels like the end of the world, but the existence of a crash does not automatically mean the end of a larger trend. Crashes often happen inside bull markets precisely because bull markets attract leverage, and leverage creates fragility. Crashes are resets. They remove weak hands. They drain froth. They remind everyone that easy money is a temporary illusion. Crashes also create a strange kind of honesty. They show you exactly where your risk tolerance really is, not where you wish it was. If you couldn't sleep last night, your position was too big. If you were forced to sell because of a margin call, your leverage was too high. And if you were able to watch the chaos and still think clearly, you just learned a superpower most market participants never develop: emotional control. Remember this too. The fact that silver could crash from the $117 area is proof it reached the $117 area in the first place. A year ago, the narrative had it closer to $30. Big bull moves don't end because the chart gets scary. They end when the drivers disappear. Until then, the market's favorite trick is to make the ride so painful that you quit right before the next leg. The next chapter depends on whether silver can digest the move, whether it can hold key levels, whether real demand stays firm, whether inventories and premiums confirm tightness, and whether the margin backdrop adds more pressure or lets the market breathe. And if silver eventually breaks through that same multi-decade resistance line, if the ceiling finally gives way, then the question becomes, what does a breakout look like after a reset like this? In 2008, the touch was around $8 and the run carried toward $45. Today, the touch happened at a completely different price level. If the market ever clears that line decisively, the next move could make the last year look like a warm-up. I'm not telling you it will happen. I'm telling you that's why the line matters. If you want one sentence to keep on your desk after a day like this, it's this: volatility is the admission price for outsized outcomes. That doesn't mean blind bravery. It means structure. It means sizing. It means patience. The market can stay irrational longer than a leveraged account can stay open. And that reality doesn't care how strong your conviction is. And finally, if you're tempted to make an emotional decision because today felt historic, zoom out again. In 1980, people swore precious metals were finished. In 2011, people swore the same. Time kept moving, cycles kept cycling, and new highs eventually showed up. History doesn't repeat perfectly, but it loves to rhyme, and the rhyme is simple. The crash always feels like the end while it's happening. Later, it often looks like a chapter break. So don't let one candle write your entire story. Study the level. Respect the leverage. Watch the real indicators. Stay patient. Stay solvent. Stay sharp.